I'm Jill Davidson, the Group Regulatory Director, and I'm delighted that you're joining us today to hear about what the changes are in terms of the pension freedoms. We've listened to a number of our advisors and we've taken the opportunity to pull together an expert panel from Tenet to answer some of your questions. And I'm delighted to introduce Steve Jones, who will be the chairman of this panel.
Hello, I'm Steve Jones, Head of Relationship Management, and today I'm joined by Charlotte Willis, Compliance and Competence Manager, Simon Thomas, Head of Policy, and Ben Wright, Head of Technical Services and Research. And today we're going to look at the basic pension freedom changes and how to approach them. So, panel. To start us off, can you briefly talk us through what's changing in relation to the new pension flexibilities?
Well, the big change is the removal of the ability to take out new cap drawdown contracts, and also that the minimum income criteria for flexible drawdown has gone completely. In practice, this means for anyone aged 55 or over, you can take your pension as much as you want, when you want, subject to tax, obviously. Anyone in cap drawdown who makes withdrawals in excess of the prescribed limits will automatically trigger Flexi Access Drawdown. And with this comes a reduced annual input allowance down from the £40,000 normal allowance to £10,000.
Yeah, I mean, the requirement for pensions now to be used solely to provide an income in retirement has largely disappeared. This sort of gives a lot more sort of freedom of choice as to how you actually apply that pot of money, but ultimately you've still got to be able to meet your needs in retirement. One of the other big changes is the rules around what happens afterwards. You know, pensions have become inheritable. If you die before 75, you can actually sort of pass that income on free of any tax, so the individual can cascade wealth down to their family.
Okay, basically, yeah, just more freedom and choice. But with that becomes more opportunity for the client to make bad decisions. That's where our advisors come in, to make sure that the client is in a fully informed position. The risk of any retirement plan is running out of money and not being able to support essential expenditure. And with more freedoms, there's more opportunity for this to happen to clients.
So real positive changes, lots of opportunities, but the real need for advice. So what options are available to clients to support their living in retirement needs?
Well, as before, clients can access flexible drawdown, now called flexible access drawdown, which can be with or without unit-linked guarantees. In addition to this, there's also the ability to take withdrawals from uncrystallised pension funds. This is called Uncrystallised Fund Pension Lump Sum Withdrawal. Nice and snappy. UF Plus is the common term, and that's what we'll use for the remainder of today. So going back to Flexible Access Drawdown, this is where you've entered income drawdown post-April 15 or have exceeded the withdrawal limits on a capped income drawdown arrangement. Now, in practice, that means that the client can draw what they want, when they want, and the requirement to have a minimum income in place to access flexible drawdown has gone completely. This method also allows clients to access all of their pension commencement lump sum in one go. Now, UF Plus is slightly different in that you're not entering drawdowns at all. You're drawing funds directly from an uncrystallised pension pot. In this instance, each slice that you access will have 25% pension lump sum withdrawal, tax-free, and 75% taxed at the drawer's marginal rate of tax. The tax treatment on UF Plus is fixed and cannot be varied. And don't forget, annuities are still available and can play an important part for clients in securing a standard of living or basic income in their retirement.
Ben, you mentioned annuities as a product solution. So, Charlotte, annuities still a viable option?
Absolutely. Annuities are a really important part of retirement planning for clients because they could provide a secure, regular income to cover essential expenditure. What's more, with thorough underwriting, enhanced and impaired life annuities could offer a much higher return than a sustainable income strategy available via a drawdown solution. So yes, annuities should certainly be considered as all, if not part, of a client's retirement plan.
Yeah, it's a really important point. The new pension freedoms do allow individuals to change the shape of the income, how and when and how much they actually take over a period of time. But there's always going to be an essential level of expenditure that they need to meet. There are going to be regular bills that come in on a fairly frequent basis. You can just sort of think about your own bank statements. Where does the money go every month? So an annuity can provide a good way of securing that sort of essential level of expenditure to give a client feeling of security about how much they are spending. Well, the Department for Work and Pensions have brought out a briefing note which is available on our Living in Retirement part of the extranet, and they are sort of putting out some warning orders in terms of those people who think, I can take all the money out and I'll just fall back on the state. Well, DWP are sort of saying, look, we're going to consider, if you've basically rinsed your pension, possibly depriving yourself of that money. Don't come knocking on our door for means-tested benefits. A refusal may offend.
Okay, so good news for annuity providers. And related to that, it was said in the budget that people will be able to sell their in-payment annuities for a lump sum. How will that actually work in practice, Ben?
That's a great question, Steve. The short answer is we're not 100% sure yet. We envisage that it'll be similar to the second-hand endowment market in that clients will be able to exchange or sell on their income for the remainder of their life for a lump sum. Chances are these contracts will be heavily underwritten and based on kind of age and life expectancies. But the real key point to remember here is that clients won't be able to cash in their annuities, only sell them on, so there must be a buyer. We're not really sure at this stage how big the market's going to be, which providers will be looking to buy annuities either. However, as these flexibilities aren't coming until April 2016, for now it's just going to sit tight and wait. As things emerge, technical services and research will keep everyone posted with bulletins and guidance.
Yeah, I mean, just to add to that, there is a Treasury consultation paper, all sort of focused on creating this secondary market. And until that actually concludes, we're not going to know for certain what it's going to be. One of the proposals within there is that it is going to exclude the provider actually buying back the annuity from the vendor. I'm not sure that's such a great idea, because typically that'd be where an individual might first go. But yeah, it is a case of we have to wait and see, unfortunately, until the consultation concludes.
Okay, so in summary, it looks like annuities will continue to be an important part of an advisor's toolkit in making their recommendations and an overall solution in retirement. But another question that's frequently asked is, does a pension have to be used to generate income in retirement?
Well, whilst it's a general idea that saving into a pension is to provide you with income in your retirement, the really important thing to remember is that you need to be able to support your essential expenditure in retirement. Not necessarily desirable, but essential must be covered. If you can do this from other sources, then there's no reason why the pension can't be left invested to pass down the generations, or withdrawn as one or a series of lump sums to fund holidays or home improvements. Although if a pension is all the customer has, then it's probably going to be a wise move in the majority of cases to actually look to use that to provide an income in retirement.
Yeah. So what about repaying a debt, for example?
Yeah, as Ben's just said, the key is to ensuring the client can support their essential expenditure in retirement. What this means by repaying a loan or a mortgage, that could potentially help a client achieve that, and therefore could be more benefit than taking it as an income. It really is what's right for the individual client.
Okay, so let's look at defined benefit schemes. And what are the options for clients?
Okay, defined benefit schemes have not been affected themselves by the changes. Pension freedoms only apply to defined contribution schemes, but we do anticipate that there'll be some clients who are in defined benefit schemes who want to take advantage of the new pension freedoms. The starting point is to really look and see whether the scheme is funded or unfunded. A funded defined benefit scheme will have a pot of money from which it pays the monthly pension to its retired members. An unfunded scheme is where the monthly contributions that come in actually pay the monthly pension for the retired members. So more of a pay-as-you-go basis. Virtually all unfunded schemes are public sector, for example the NHS scheme. The deadline for transfer out of these schemes has now passed. What that means is for people in unfunded pension schemes, defined benefit schemes, the only option is to take the scheme pension, which is a secure income for life and a spouse's benefit.
Yeah, I mean, for those with funded arrangements, obviously they can take the benefits out of the scheme itself, or they could take a transfer value in order to access the new pension freedoms. But it's no great surprise that the FCA have sort of made it really very clear that their starting point is that transfers out of defined benefit arrangements start from a position of this is not going to be suitable. And the FCA have recently, in fact, put a piece on their consumer-facing website talking about pension transfers. They've also emphasised the point on there that you don't necessarily get a fair exchange of value. The cash equivalent transfer value doesn't necessarily reflect the full value of those pension benefits. So that's another good reason why it might not be such a great idea. However, having said that, the benefits out of a defined benefit arrangement are in a particular shape that might not necessarily suit what somebody wants to do in retirement. They might have a very active retirement where they need more money, and there is therefore when they're still getting that sort of regular size income, they're unable to spend it because they're not that active later on. So, is it possible to transfer out? Yes, it is. It still might be suitable, but you need to understand all the various factors, the soft facts. Critical yield is still going to be important in terms of establishing the value, but it's not necessarily everything. That the critical yield is sort of designed to look at taking benefits as an annuity by comparison. So it doesn't necessarily reflect the full pension freedoms, but more to come.
I think really it's all about doing the right thing for the client. But this is an area where advisors should be careful, as it does carry a reasonable amount of risk actually moving out of these occupational arrangements. The FCA are looking at the pension transfer market, and we can expect final guidance and rules probably in the summer. We do anticipate more interest in this area, but the significant risks remain. And after a review of all of our policy, we've concluded that it does still meet the requirements in the present regulatory environment, so there have been no changes to policy or guidance around transferring out of defined benefit schemes.
So again, it's down to individual tailored advice in individual circumstances.
Exactly.
So we anticipate more interest in this area, but significant risk remains. And Tenet's policy and guidance hasn't changed on it, it's my understanding. Has the advice process changed at all?
No, the process is really largely unchanged as a result of the pension freedoms. You're still going to have to go through the standard bits of your advisory process. Your disclosure, your fact finding, your research, your analysis, the pulling together the report, all that is still essentially part of the normal process that an advisor would seek to follow. The key bit, I guess, is that in that research phase, there is a lot more to choose from in terms of the potential solutions that you might arrive at in order to meet what the client's objectives actually are. So, as we've said sort of already, it's the recommendation just needs to be suitable to meet the client's objectives.
Yeah. So what about execution-only transactions? Are they still allowed?
Yeah, execution only is still potentially possible within the pension freedoms environment. There are a couple of sort of wrinkles within that, however. First of all, we wouldn't allow execution only to be part of the process for occupational pension transfer, for example. And even if it's money purchase, where somebody's sort of phoning up and saying, look, I want to take my money, we are sort of replicating the sort of second line of defence that providers are putting in place in terms of just checking that you've received the pension-wise guidance, so that we can assure ourselves that the client has actually taken some time to explore what their options are, and there's a reasonable expectation that having got to the point where they're asking for the money, they have actually sort of understood something about the possibilities and the options which are available to them.
Okay, and for our network members, what type of living in retirement cases require pre-sale assessment now?
Okay, that would be vulnerable clients. That includes clients who are aged 75 and above. Defined benefit transfers, cases of or above £500,000 before the tax-free cash is taken, and also income drawdown cases. But don't forget, there is a dispensation available for income drawdown cases. So to achieve the dispensation, you need to attend a one-day course run by Tenet. You need to complete a case study and a knowledge test, and then submit 2 cases that meet the Tenet advice standards for pre-sale assessment.
Okay. There's a lot of publicity around at the moment about pension-wise and so on, and I can see a lot of clients or people just looking for information because of the freedoms. Can advisors offer guidance services around the new pension changes?
Well, yes, they can. But again, there's a real need for caution. Whilst it's perfectly acceptable for advisors to offer guidance, under no circumstances can they suggest that their guidance either replaces or forms part of the government guidance guarantee, which is currently available through PensionWise, the Pension Advisory Service, or HM Treasury's website, because there is a legal prohibition on that. If you're approached for general guidance, I would say as a rule of thumb, you should direct the clients to the approved guidance channels. If they want your personal advice, that's where your job as a financial advisor comes in.
Yeah, I mean, just consider this from a commercial perspective. You know, the pension-wise services are being provided free to the consumer, and you know, you've got to ask yourself the question: do you want to compete with free? That's quite a challenge. Yeah, pension-wise, it cannot tell the client what they should do. They can only tell the client what the options are, what they could do, and so there's a real difference between you know, what each can do. Best to keep them separate.
So yeah, thank you. So you know, in summary, the advice process remains largely unchanged. There are added complexities for sure. Obviously, increased choice, which means good financial advice is paramount, and huge opportunities for financial advisors. In our next panel session, we're going to be talking a little bit more about the assistant client process and on order taking. But with all the changes, there's certainly a lot to consider. And what resources are available to help advisors?
Well, the great news is, Steve, that there are lots of resources available to help advisors on our extranet. For starters, we now have a dedicated living in retirement area on the extranet, where everything to do with the subject has been pulled together into one place, including key excerpts from the compliance manual. In addition to this, we've also redesigned both the fact finds and the suitability templates for the living in retirement area, and also updated the panel with some of the new information about freedoms as to which providers and products offer access to funds. We've also launched the Tenet Cash Flow Analyzer tool to help advisors plan for their clients' income in retirement. Now, we're working really hard to try and give advisors the best possible resources available. However, you know, we are open to other suggestions. So if any advisors think that there's something that would really add value to them, then please do let us know, and then we can consider whether and how we can provide that to them.
Okay, Ben, Simon, Charlotte, thank you very much for your time.